Good morning, everyone. Welcome to the July Citrus Seminar. Thank you for joining us. First, I would like to thank Alison Walton from the Southwest Florida Research and Education Center in Immokalee for her help and cooperation. Today's program offers 1 CEU for pesticide license renewal and 1 CEU for certified crop advisors. If you need CEUs, email me your name, email address, and license number. Our guest speaker is Dr. Ariel Singerman, Associate Professor in Agriculture Economics at the UF-IFAS Citrus Research and Education Center in Lake Alfred. The title of his presentation is The Economics of Oxytetracycline, OTC, Applications and Crop Insurance. Before Dr. Singerman gives his presentation on economics of OTC, I will give you a brief presentation on the horticulture aspect of OTC. Research results indicate that trunk injection of OTC reduces fruit drop and increases fruit yield, breaks fruit size, and tree growth. Injection occurs into the xylem, but the material is distributed throughout the tree with the transpiration stream. Advantages of OTC injection: precise delivery of material, elimination of spray drift, reduced risk for worker exposure, reduced risk for non-target organisms, reduced pesticide load into the environment, and longer residual activity of the material. The major concern with OTC injection is the possibility of tree injury. Some recommendations for OTC injection: inject after harvest and after the bloom to prevent any harm to pollinators. Inject when leaves are fully expanded to ensure good uptake and distribution of injected material. Uptake and distribution of injected material are driven by transpiration. Inject during mid to late morning when trees are actively transpiring. Injection in the afternoon are less effective and may increase the risk of phytotoxicity. Avoid injecting when it is hot. Don't drill the hole too deep. Do not use any wound sealants or plugs to seal the holes. Trees will get reinfected. Therefore, OTC injections are not replacements for psyllid control. It is not recommended to inject trees with a trunk diameter of less than 2.5 inches. Inject trees only once per year and leave a pre-harvest interval of at least 180 days. Be sure to follow label directions.
Okay, out right there.
Again, our guest speaker today is Dr. Singerman. His talk will provide you with estimates of the year-to-year cost and break-even yield for OTC injections. In addition, his talk will provide performance estimates of crop insurance policies for citrus in the last 2 seasons, which might be useful for growers to evaluate their current coverage. Dr. Singerman, it is all yours. Please go ahead.
Thank you, Mongi. Good morning. So my presentation is going to be divided into two. In the first and main part, I'm going to talk about the economics of OTC. And then in a second and shorter part, I'm going to discuss the performance of two crop insurance policies in the last 2 seasons. Now, before I get into the economics of OTC, let me share with you a few slides that I put together regarding the changes in orange yield in the last 30 years statewide, because I think those are going to be important for the analysis that follows. So in this first graph, what we see is orange yield in Florida. And so on the vertical axis, we have boxes per acre. And on the horizontal axis, we have seasons going from 1993-94 to 2023-24. So 30 years of data. And you can see that I divided this period into three. The first sub-period goes from 1993-94 to 2003-04. So that is prior to HLB. And what that black denotes over the yield data is that that yield on trend was increasing. After that period in 2004, if you remember, we had back-to-back hurricanes. In 2005, we had another hurricane. And then in 2006, we experienced a freeze. So all of those weather events significantly impacted yield. Now, after those weather events, yield started to go up back again. But as we all know, HLB was already around since 2005. So in the period that goes from 2007-08 to 2016-17, we can clearly see a significant downward trend for yield. Since there were no other significant weather events, we can attribute this to the pure spread of HLB throughout the state. In 2017, we had Hurricane Irma, and after that, yield went back up again, but only to start a new downward trend that is even steeper than the one we had before, because I would argue that HLB combined with other factors, including the skyrocketing of input prices and the rock bottom prices that oranges got after processors had made contracts with people in Mexico and Brazil. So we can also look at the changes in yield, looking at the data at the state level, but by tree age group. And this is what that looks like. So in this graph, what we have is the yield for Valencias. So the vertical axis is yield in boxes per tree. And then on the horizontal axis, we have tree age group in years old. So we have 3 to 5-year-old, 6 to 8-year-old trees, 9 to 13, 14 to 23, and 24-plus-year-old trees. We have the exact same subperiod as before. So the red bars denote the period that goes from 1994 to 2004. And what we can see is that each tree age group produced more than the previous one. So as trees mature, they yielded more. The green bars denote the impact of the spread of HLB, as we saw before. And we can see that for each tree age group, that yield decreased quite significantly. But still, what we can see is that there was the same trend in the sense that each tree age group produced more than the previous one. Now, in the blue bars denote the period that goes from 2019 to 2021. And we can see that, again, we see a drop in each of the tree age groups' yield. But now, one noticeable feature that we see is that the 24-plus-year-old trees no longer produce more than no longer produce more than the 14 to 23-year-old trees. So there seemed to be an increase in the decline of those trees. And in fact, what we can do to make the comparison more fair across the different tree age groups is to present this yield changes in percentage change. So this is what I do in this graph. This is measuring the yield percent difference for the different tree age groups. And so now the green bars denote the change in yield from 2008 to 2017 relative to the previous period, 1994-2004. And what we can see is that, at least for the case of Valencia trees, the tree age group that suffered the most impact was the 3 to 5-year-old trees, which suffer a yield decline of almost 40%. The ones that follow were the 14 to 23-year-old trees and the 24-plus-year-old trees, which experienced approximately 36% decline. The group that suffered the least, but still significant, a significant decline of 25%, was the 9 to 13-year-old trees. Now, the pink bars denote the change in yield from 2019 to 2021 relative to 2008, 2017. And we can clearly see that the group that suffered the most was the 24-plus-year-old trees. Now, I find this data not only interesting, but also relevant in the context of OTC applications, because, for example, if growers were to see a similar pattern of decline in their trees, particularly the ones that are 24-plus-year-old trees, they might want to take this information into account when deciding whether to apply OTC or not. Now, getting into the economics of OTC, I want to state right up front that I do not have data at the farm level to be able to establish the yield response or the profitability of the treatment in a specific grove or a set of groves. Instead, what I have is state-level data for yield, like the one I just shared with you. So this is to illustrate the calculations that individual growers might want to follow to figure out whether OTC trunk injections make economic sense in their own groves. So the steps that I will take in the analysis that I will share with you is, first, I will find the yield increase that is needed for break-even in this past season, 2023-24, but at the state level, and compare that break-even yield to the estimated yield increase in this past season. And then I will use some assumptions to compute relevant scenarios going forward. Now, for the economic analysis, it is important to consider that the OTC applications and the yield response occur at different moments in time. And so for that reason, I always find it useful to start with a timeline. And so what we have in this timeline is that there was the first application last year, a second this year, and there is likely to be one next year, but we still do not know. So what we have so far is that growers had to afford a cost last season, another one this season, but there was also a yield response that we got this season from last year's application. However, this is also a hurricane recovery year. So there are two yield responses combined. And then there might be a third cost next year if OTC applications are approved. And then there's the benefit from this year's application. And then in 2026, there might be a benefit from the third year application. And even if there is no application, there could be some potential for a residual, if you want to call it that, effect or benefit from the applications during the first 2 years. So what we know so far is what has already happened: the cost last year, the cost this year, and the benefit. And then we do not know what will happen in the future, the area that is shaded in orange. Another important concept in having different cash flows at different moments in time is that when we do the analysis, we want to bring them all to the present value in order to make a proper economic analysis. So if any cash flow occurred last year, like the cost, we want to compound it to bring it to today present value. And if it will happen in the future, we want to discount that expectation in order to, again, compute the present value. Now, the cost of OTC trunk injections on a per acre basis depend on variables such as the age of the trees, the health of the trees, and the tree density. So it makes more sense for me to show the calculations on a per tree basis, because it would be impossible for me to try to represent what an average grove looks like. And so in order to do this, I match the trunk diameter that appears in the label of the chemical to the data that I have by tree age groups. So the thinnest trunk diameter corresponds to the youngest tree age of 3 to 5 years old, and so on and so forth. And using data from the USDA at the state level, I was able to estimate what was the yield for 2022-23 for Valencias. Also, using data from the FDOC for this past season, their latest estimate for the price of Valencias was $3.21 per pound solid. And on average, they got 4.95 pound solids per box. Taking into account the FDOC tax, the harvesting cost, I can calculate the price on tree, which was $11.31 per box. So starting with the costs. In this table, what we have is the cost last season. So the estimates that you see correspond to 2022-23, the first application. And we have it for the chemical, for the injector, and for the labor. So the cost of the chemical changes because a different rate is needed for each of the different trunk diameters. I am assuming that the cost of the injector last year when things started was $18 per injector. And so since I'm assuming 150 trees to the acre, that comes down to 12 cents per tree. And I am assuming that the labor is $1.20 per tree. Now, I am aware that growers can have lower costs than this, that they face lower costs than this. But what I'm considering here is, if you will, what would a caretaker charge? And the reason for that is because they would take into account the overhead associated with the cost of the application, whereas growers might not take that into account. Now, of course, since this might better represent the cost or the charge of a caretaker, this includes or might include a small profit margin. Now, this year, the cost went down, particularly for the injector, because growers were able to figure things out a little better. They were able to bring the cost down, I estimate, to $6 per injector, and so that comes down to $0.04 per tree. And the labor also came down a little bit because their growers, again, there was a learning curve, and so growers were able to achieve some efficiencies in the application of the OTC. So now that we have the different pieces of the puzzle together, we have the price, we have what was the yield last year, and now we have the cost, I can then estimate the break-even yield. And that is what we have in this first graph. In this graph, what we have in the horizontal axis is the total cost of OTC application in dollars per tree. And on the vertical axis, what we have is the yield increase that is needed for break-even in boxes per tree. As I mentioned a few slides ago, we have to bring back whatever the cost was last year to the present value. And so last year, the cost of application to 3 to 5-year-old trees was $1.38. Now, I need to compound that, and I am assuming that the cost of capital is 10%, so that brings that value to $1.52 per tree. And if that is the case, then the yield that I calculate is needed for break-even is an increase of 0.135 boxes per tree. That represents a 67% yield increase relative to the average of that tree age group of 0.2 boxes per tree. For 6 to 8-year-old trees, the present value of the cost last year is $1.59, and so the percentage yield that is needed for break-even is a 56% yield increase relative to that tree age group average yield. For 9 to 13 years old trees, it's 53%, and for 14 to 23-year-old trees and 24-plus-year-old trees, the present value of the cost last year is $1.87. So the yield increase that is needed for break-even is 0.166 boxes per tree, and that represents a 40% yield increase relative to that tree age group average yield last season. Now, of course, a single grower might have gotten a higher price than this, let's say $13.14 per box. And if that is the case, of course, that the yield increase needed for break-even would need to be lower, and so will the percentage yield increase that is needed to achieve that. So for 3 to 5-year-old trees, that would need to be 58% yield increase, or 0.116 boxes per tree, instead of a 67% yield increase. For 6 to 8-year-old trees, that percent increase would need to be 48% instead of 56. For 9 to 13-year-old trees, that would need to be 45 instead of 53. And for 14 to 23-year-old and 24-plus-year-old trees, that yield increase would need to be 0.143 boxes per tree, which represents a 35% yield increase instead of a 40% yield increase. Now, again, using the data from the USDA at the state level, I was able to compute last year's yield, this past season yield, and so I was able to also compute the yield increase that was that is at least estimated to have occurred. The question now becomes, how do those estimates compare to the yield increase that I just shared with you that are needed for break-even? So going back to this graph, if that occurs on the line, if that yield that was obtained is on the line that is shown on the screen, then we attain break-even. If it's above the line, then that means that it's profitable. And if it's below the line, then that means that it is not profitable. So for the 24-plus-year-old trees, what I estimated the yield increase was this past season at the state level is 0.09 boxes per tree, which is well below the 0.166 that was needed. And so that falls in the lower side of the screen, in the shaded area that is in red. And so that does not achieve break-even. And neither does the 14 to 23-year-old trees, the 9 to 13, the 6 to 8-year-old trees, and the 3 to 5. However, in this previous analysis that I just quickly shared with you, what I am assuming is that all of the trees statewide were treated with OTC. Now, I do not have data to determine what was the statewide adoption rate of OTC, but I do know that it was not 100%. But given that I have yield data and average price, I can compute the maximum adoption rate of OTC last year in 2022-23 that is compatible with the yield increase that is necessary for break-even for all 3 age groups, except the 3 to 5-year-old trees, because the 3 to 5-year-old trees really yield too little to be able to break even. Growers typically would want to apply the treatment to them as an investment in their future, but they are unlikely to reach break even. So the statewide adoption rate of OTC that I estimated is compatible with break even is 54%. Now, if the adoption rate of OTC last year was higher than that, the observed yield increase that I estimated in 2023-24 would not be enough to break even. Another important consideration is that the previous analysis also assumes that 100 of the yield recovery, that 100 of the yield increase from 2022-23 to 2023-24 was due to OTC trunk injections. But recall that in 2023-24, we also saw a hurricane recovery. And just as a reference, in 2018-19, the yield increase from Hurricane Irma was 60%. So the question now becomes, how much yield increase in 2023-24 was due to OTC response and how much was due to Hurricane Ian recovery? Now, assuming again that an OTC statewide adoption rate was 54%, the OTC yield increase would need to be, according to my estimates, 92%, which means that the iron recovery estimate would need to be 8 to get to 100. And that would be to attain break-even for 3 age groups 6 to 8, 9 to 13, and 14 to 23-year-old trees. The 3 to 5-year-old trees, we already mentioned, are unlikely to achieve break-even, but also under these assumptions, the 24-plus-year-old trees do not achieve break-even. And that is likely because of that higher decline that we saw at the beginning. Now, it is quite unlikely that the yield increase due to hurricane recovery was only 8%. It is more likely to be higher. So let's just assume that it's 50-50, so that OTC accounted for 50% of the yield increase, and the hurricane recovery was another 50. Given that I had estimated that I needed at least 92% of the increase to come from OTC, what this 50-50 means is that the yield response to OTC next season would need to be higher in order to be able to achieve break-even. So what I can do now is compute the yield increase needed for achieving a cumulative break-even next season in 2024-25. Such yield increase would need to cover the portion of the 2022-23 OTC application not covered by the yield increase in 2023-24, plus the 2023-24 OTC application cost that growers faced earlier this year. And when I do the calculations, this is what I come up with. So the cumulative total cost is now what we have on the horizontal axis for 24-plus-year-old trees is $2.45. And in order to achieve break-even, the yield would need to increase by 0.217 boxes per tree. That represents a 43% yield increase relative to this past season average for that tree age group of 0.5 boxes per tree. For the 14 to 23-year-old trees, that cumulative total cost is $2.24, and so the yield would need to increase by 38% relative to that tree age group average this past season. For the 9 to 13-year-old trees, that cost would be $2.19, and so the yield increase would need to be 51% relative to 0.38 boxes per tree. And for the 6 to 8-year-old trees, that cumulative cost is $1.92. And so the yield increase needed for break-even is 0.17 boxes per tree, which represents a 50% yield increase relative to that tree age group average this past season. Now, again, this is assuming that the price in real terms will stay unchanged, so that will be $11.31 per box. But of course, if price were to increase, all of the estimates for the yield increase needed for break-even would need to be lower, and so will the percentage increase relative to this past season average for each tree age group. So the take-home messages from this analysis are the following. This past season was the first following the OTC trunk injections, but it was also a hurricane recovery season. It is not clear yet what was the share of the yield response corresponding to OTC and to hurricane recovery, so I just assume it's 50-50. And using state-level data and the descriptions that I mentioned before, what I found was that the yield response to OTC in 2024-25 would need to increase to cover the portion of the 2022-23 OTC application not covered by this past season state average yield increase and the 2023-24 OTC application cost. Now, something that I want to make clear is that in the analysis, the potential benefit in year 3 from the potential application of OTC application next season is not considered because it's yet not clear whether they will happen or not. And finally, what I want to also make clear is that these results cannot be used to establish whether OTC trunk injections work or whether they are profitable at the farm level. The only purpose of this calculations that I just shared with you is to illustrate the calculations that individual growers might want to follow to figure out whether OTC trunk injections make economic sense in their own operation. And this is because each grower knows how much they have spent on the application and how much they have seen as a response in this past season. So this concludes this first part of the presentation. Let me just quickly go over the second part, which is the performance of 2 crop insurance policies in the past 2 seasons. And then we will have time for questions. So there are 2 main policies that citrus growers in Florida use to insure their crops. The first one is the reference maximum dollar amount per acre. And this policy provides coverage based on a dollar amount set arbitrarily by the risk management agency. The second one started to be offered in 2022, and that is the actual production history. This policy provides coverage based on the farm's historical records, and the basis for the guarantee is the average yield for the last 10 seasons. Now, given HLB and its continuous impact on yield in Florida, as we saw in the very first slide that I shared with you, the coverage based on past seasons causes the guarantees under this program to be higher than what they would be otherwise. So let me share with you the analysis of the data that the risk management agency puts out on the performance of each of the policies. And this first slide is for the year 2022. And so we have APH and dollar amount, and we have 3 columns. Coverage level, which is the one that growers can choose. We have the number of policies sold under each of those, and the number of acres enrolled. So under APH, there were 209 policies sold that cover 38,344 acres. And under dollar amount, there were 1,198 policies sold that cover 220,398 acres. Now, in both cases, most growers chose the 60% coverage level. And adding now some more columns, we can see in column 4 the number of policies that received indemnity under each of the programs, and the percent of policies that received indemnity, and the average indemnity per acre. So under APH, 161 policies out of 209, that is 77% of the policies, got an average indemnity per acre of $726. For dollar amount, there were 365 policies out of 1,198, that is 30%, got an average indemnity of $153. And even when we take the average premium into account, the payoff, if you want to call it that, after subtracting the premium, under APH was $703 per acre on average, and under dollar amount, it was $134. So not only APH was more likely, more than twice as likely to pay an indemnity, but it was also significantly higher the amount that it paid. And in 2023, this was Hurricane Ian's year. The number of policies sold under APH was 227, so it increased a bit. The number of acres enrolled increased a bit more. It was 54,934. And for dollar amount, there were 1,012 policies sold for a total of 147,857 acres. And again, most growers in both cases chose the 60% coverage level. Now in 2023, 205 out of 227 policies, that is 90% of them, got on average $958 per acre. The dollar amount paid to 656 policies out of the total of 1,012. That makes it 65%, an average of $892 per acre. And when we take the premium into account, the average payoff of APH was $941, whereas the one for dollar amount was $872 per acre. There were 2 cases, the 60% and 80% coverage, that got on average a higher pay than under dollar amount relative to APH. But if you take a look at the number of, at the percentage that got indemnity, it is significantly higher for APH relative to the dollar amount. So from this, what we can learn is that in 2022 and 2023, Florida orange growers were more likely to receive an indemnity under APH relative to the dollar amount. And they were also, on average, they also received a higher indemnity under APH. Now, there are a few considerations here. The risk management agency standards for this APH program include testing variability in yields to determine whether there's any adjustment to be made. The test for a downward trend establishes that an adjustment is implemented if the average yield of the last 3 seasons decreases by more than 25% relative to the average yield of the last 10 seasons. And if that is the case, the guarantee is reduced by 20%. So as long as the downward trend continues and RMA's test for it does not trigger the adjustment, obtaining the coverage under APH will likely continue to be beneficial for growers. This concludes the presentation, and I'll be glad to take any questions that you might have.
Any question for Dr. Singerman? There are some questions and comments on the chat box.
Okay. So the first one is, did you include the increase in solids from the injections in your calculations? The answer is no. I just took the average that the FDOC computed as the average for the state. So when doing that, it is implied that if there was, again, I'm using state level average, and so state level data. So the average should include any increase in the pound solids for those trees that were injected. Then there's another one that says OTC adoption is 84% according to the Citrus Industry Magazine of July 2024. So yes, I did see that estimate of adoption, but I do not know how that data was collected. So maybe it was collected among 100 growers, and most of them had applied OTC. So since I do not know what was the way in which the data was collected, it was not a random sampling, then I just couldn't use it. But I did see that estimate before.
Any other question or comment? Thank you, Dr. Segler.
You're welcome.
Again, if you need CEUs, email me your name, email address, and license number. And thank you all for joining us. And we will see you next time.